Natasha Macho. I'm the Client Relations Manager here at IRA Club, and my guest is Whitney Hutton from Goodegg Investments.
So I do this webinar series on a weekly basis with Goodegg Investments, and essentially it's centered around how to get started as a passive investor, even if you have never invested in real estate before. Now, I know a lot of people probably on this webinar have owned their primary house, and guess what? That is, you do have real estate experience. But when we start talking about some of these passive investments, a lot of times we haven't drawn a tangible line for you to repurpose the skills that you acquired to buy that house to help you understand how that you might actually have some current background already to evaluate a passive deal. So let's bust through one of those big myths. And one of the biggest lies that investors tell themselves about passive investing, the reason why they never leverage their SDIRA to invest passively, is they say, I have no control of the asset. I can go buy a rental property and hold it in my name, and I feel like I have more control, right? I can touch the house, I can feel the house, I can do work on the house. Well, you can't do that. Like as Kasha already told us that, you can't do that if you invest passively with your SDIRA. So we have to be able to be comfortable with, evaluating the people that go onto our team, and so you feel that control, okay? The other thing that investors tell themselves if they invest passively that they won't make that high of return, which simply isn't true, okay? And if you guys join me on one of our weekly webinars, we break down all the different, the math around that, why you can actually make a higher return if you invest right in a passively deal than you could if you held a deal personally in your name, okay? Now, what makes me any sort of like expert to talk about this? Well, this is my story. The reason why I learned how to invest passively is so I could actually spend more time with my family, traveling the world. And actually, this picture, I mean, granted, 2020 was a interesting year for all of us, but this, we were able to kind of pull up stakes and move to Sedona for the wintertime and just like play. We had orchestrated our lives this way, but it wasn't always like that. I started off real estate investing in 2002, and I was doing what we call live-in flipping and house hacking. So I was buying the house, stuffing it full of roommates, rehabilitating it, and then selling the house off for more money, which is fine and dandy. I could make money that way, right? I had that lie that I was telling myself that I could make a higher return. But what I wasn't taking into account was the return on my time. I was losing out on that time. I still didn't have passive income coming in. I was relying on my job to stabilize my cash flow month to month, all right? And it really, we can, pick apart my experience, but, it took a few years for me to understand getting into passive real estate, where you have capital preservation, you have cash flow coming in, you are buying with a reasonable chance of appreciation. And then, of course, all the tax benefits that come with investing in real estate. That is what accelerated my wealth build, is when I was able to tap into all those different pillars. So we shifted into investing purely passive in larger multifamily, self-storage, and mobile home park deals. And in just 3 years, this is our track record with Goodegg Investments. We've invested in over 26 multifamily deals, 2 self-storage, and a mobile home park. We have over 6,700 multifamily units under management and $800 million portfolio. My role here at Goodegg Investments is working with you guys, investors, okay? So we have over 900 verified investors in our database and a very high repeat investor rate. So you guys aren't here to hear me talk about me or hear me talk about Goodegg. You're here for the goods, okay? How can we help you understand what passive investing is, put that control back in your pocket, help you screen deals very effectively and quickly, efficiently, and then arm you with a checklist of red flags, okay, things that you need to mitigate whenever you're evaluating a deal. All right, so let's talk about the 3 secrets that we have for passive investing. What do we need to control here? Well, the first thing that we need to learn how to control is the operator, okay? When we invest passively, okay, we are moving away from buying a rental house and having it in our name, or having our own personal house, okay, having an asset that's in our name that we can touch and feel. And we have to flip that paradigm on its head. We now have to go find the operator that has the deal. Okay, so think of it this way. You have to understand that you're investing in an operating business. All right. Two, once you define who that operator is going to be, and again, I'm going to give you a checklist. All right. You now want to understand where they are investing. Okay. How can we choose a market to invest in without being a data genius? Then, only then, once we got our good operator, our great operator, and a great market to invest in, do we start actually physically looking at the deal. So when we're choosing an operator, again, this is the person, okay, this is the team that is going to be running the deal day to day for us, okay? Think about this. They're the CEO of the company that you're handing over your hard-earned money to. So we want to understand a few things whenever we speak to this operator, okay? Essentially, this is your interview list. Okay, what is their investment philosophy? All right, here at Goodegg, we believe our investment philosophy is very simple. We believe in capital preservation first. That's why we love real estate and real estate correlated assets. Okay, we believe it gives you a lot of capital preservation there. We also believe in assets that cash flow and have a reasonable chance for appreciation. Okay, we are actually trying to pull both of those levers at the same time. And why would we do that? Is because we're very focused on the investor that's serious about building balanced wealth for their family through both cash flow and through appreciation. All right. And then the fourth pillar of our investment philosophy is we're looking for investments that have tax-advantaged benefits to them. So why real estate? Is because we can actually generate depreciation. The IRS is kind of our partner, and we can generate depreciation and sometimes accelerate that depreciation through a cost segregation analysis to the early years of the project. Now, if you're investing with your SDIRA, guess what? You can't use the depreciation, but you can suspend that within the IRA. And again, work with your tax professional on this. You can suspend it and use that depreciation to offset any gains at a later time. Number two, what do they invest in? Okay, this is where you want to really truly understand what intrigues you about the investment you're going into. Do you like, real estate is a broad area. Do you like multifamily, self-storage, mobile home parks, mixed-use development, commercial higher end developments like hotels and stuff like that? Okay, you want to really understand what that operator is truly investing in and make sure it aligns with what your interests are. Now, are they competent? Again, you're hiring a CEO to take care of your money. Are they competent? Can they do this? Do they have a track record? You want to take a look at their current deals that they're running or that they have under management. What are the returns on that? Are they meeting and beating expectations? Do they have previous deals? What are their performance on those? What are their exit been like? Have they been hitting their returns? Do they work with a sophisticated or accredited investor? Okay, so this gets down to investor suitability. Some operators only work with accredited investors, and you'll typically see what we call a 506C designation to their investments. Others work with sophisticated investors, and those guys can be a little harder to find because they can't advertise their deals. They're typically what we call a 506B, B as in boy, investment. So, how do you find them? Well, conferences, networking groups, meetups, asking other investors, who they're partnering with. That's a great way to start. Number 5, get references. Okay, talk to other investors that have invested with that operator before and understand what their experience has been like. Again, you're not looking for 100% glowing references. You're looking for investors that have a high regard for how that operator has communicated to them, handled certain scenarios and bumps in the road. Right? And then number 6, I call this the gut test. All right, if you're talking to an operator and they just don't pass your gut test, they're not happy to hear from you. You feel like you're being filtered or whatever. They're just not making you feel all warm and welcome. Listen to your gut, okay? Now, again, let's shift to the market. Okay, again, I'm trying to give you guys a crash course on how to get into passive investing. And we said the number one thing that you had to control was the operator. You get to choose who you place your money with. You also now get to choose what markets they're investing in, okay? So, and I'm gonna give you a primer whether you've never underwritten a deal before or you're very proficient, okay? I'm gonna give you a checklist, okay? You're gonna be able to do this yourself. Real estate is an illiquid asset, okay? I don't know of any asset, like if you invested in a self-storage building where you can dig it up and move it to another county if you don't like the law changes there, right? It's all about location, location, location. And I think of it this way. I want to stack all of these investing cards in my favor from the very beginning. So let's jot down a few things that we want to take a look at. I love looking for markets where population is growing. Okay. Now, I personally love primary, secondary, and just outside the secondary market, kind of getting in the tertiary markets. Now, that said, this checklist would apply to any primary, secondary, tertiary market. Okay. But look for areas where the population is growing. We want to make sure that people are moving to the area. Doesn't matter if it's mobile home park, self-storage, multifamily. Okay, we want to make sure that people are moving to the area and that there's going to be enough people to rent to and to utilize that asset. We also want to make sure that they can afford the asset. We want incomes to be growing. Okay. If we're dealing more with mobile home park or multifamily investing, we want to see that that median house price, that home value, is actually growing as well. That not that housing prices are declining, but they're increasing. Okay. We want crime to be trending down. Okay. Owning an asset in a high crime area, again, it's all about location, location, location. All right. We don't want to own assets in those high crime areas. Also, I want to be an area where the jobs are growing with a good industry mixture. My rule of thumb is that no one industry has more than a 25% market share. I actually like it well below 20%. Why is that? Because as we saw last year with COVID, some industries can get, essentially turned off overnight, or closed overnight. So I want to make sure that there are other jobs in different sectors of the market to kind of account for that and cushion the blow. We also want to make sure, again, median income is growing. We talked about just income in general growing, but we want to look at the median income in that market. We want to make sure the two are growing together because they actually aren't necessarily correlated, or they are correlated, but they don't necessarily have to be growing together. We also want to make sure that the rent, especially if we're dealing with even self-storage, mobile home parks, multifamily, that the rents are affordable. Okay, they're attainable, right? Almost anybody can, or a good 80% of the market can actually achieve that rent, but that the current rents aren't at market rent. We don't want to be the top dog in the market. Okay. I like drawing tandems back to people's personal lives. If you own your home, you might have taken a look at your primary house and said, I want to pay $10,000 or $20,000 under what the top dog is in my market. Again, you just don't want to be at the very top. You want to have room to grow. We want to make sure the unemployment rate is trending down. Okay, so maybe it's close to the city unemployment rate, but definitely trending down. Okay, that's been kind of hard to suss out over this past year with COVID. So I've been looking for unemployment rates to be, COVID adjusted. Okay, so they've been flat. If you take into account the current blip in the market. Also, we're looking for low poverty areas. And then number 10, landlord friendly areas, especially if we're dealing with mobile home parks and multifamily and mobile home parks. We want to make sure the laws are in the landlord's favor. Okay, and the reason for this is then they're more pro-business. You get to choose how you're going to run that asset. And we found, of course, over this past year, we actually, in our markets where we had, a heavier tilt to landlord friendly, we actually were able to work with our tenants far more readily than in some of the areas where we were more neutral on landlord-friendly laws. So we want to make sure that we're in landlord-friendly areas. So again, you can maintain control of that asset. Taxes are one of your number one expenses, okay, on any asset, real estate asset. Is that asset that the operator is looking for in a market that is going to have favorable tax treatments? Okay, I look for markets where the tax treatment is definitely under 2.5%, if not 2% or under, okay, and that's at the state level. So here's kind of a understanding, or like how I would put together, a checklist on if I were investing in a value add B class deal. Why do I say that? Because under my ideal column, this is what I'm looking for. I'm looking for, again, B class-ish type asset, and I'm looking for more of a value add approach. So that said, if you're looking for more of an A class asset, you might move your ideal column, the second column to be your ideal column, all right? So we'll just run through this. For us, at Goodegg, we like looking for the value add B class deal. We like 100 units or more. We're aiming for a 2x multiple. And the internal rate of return, we're targeting, 14 to 20%. We definitely love staying above that 16% if we can. We love non-recourse agency debt if we can get a Fannie Mae, Freddie Mac loan. We love fixing our interest rates for 5, 7, 10 years or longer. We always underwrite to a reversion cap rate, meaning you're going to see its sensitivity spread from us on the particular returns on the asset where the market goes up, down. And then again, we do never like to be the top dog in the market. We love to make sure that we have like room to grow and not be the market leader. Okay, it's great if we turn into the market leader. We've had that happen on a couple of our assets, but we definitely want to make sure that we have room to stay competitive in the market. And again, making sure that our rent, projected rent growth is very conservative at like 3-4%. Okay, we don't get into inflating our rent growth there. And then also our projected vacancy, we like to keep our projected vacancy definitely between 5 to 10%, closer to 10 if we can. All investments carry risk. I don't care who you're talking to. All investments carry risk. And it's not that, operators are trying to scare you or anything like that. I think we just don't talk about risk enough, especially when we're transitioning as an investor away from stocks, bonds, mutual funds, and into this more self-directed environment. We're transferring the risk. One, the capital call, all right? The operator may need to call for more capital in an unforeseen circumstance, okay? And we're going to talk about how to mitigate these, so don't get too nervous yet. You can have a capital call on your primary residence, right? Your HVAC goes out, right? You have to all of a sudden infuse more money into the property than you were thinking that you would have to that year. Distributions, okay? The operator may need to suspend distributions to keep the cash accounts well capitalized, okay? To help you preserve the asset. Now, if you have your own single family rental, this just means your tenant didn't pay that month for whatever reason, or maybe you had a vacancy. And then the business plan risk. Okay, the operator may need to significantly change the business plan in light of market conditions, obstacles, and unforeseen events. I said I was going to help you mitigate some of these risks. I'm going to tie it back around to the beginning. The way we mitigate these risks is to understand, go back to our core pillars. We want to invest for capital preservation. Rule number one, we want to look for assets that preserve capital. Don't lose money. Okay, Warren Buffett's rule number two, so rule number one, don't lose money. Okay, that's why real estate, we really truly love real estate and self-storage, mobile home parks and all that. We love cash flow, okay? If we can stack all of these, the operator, the market, and the deal, and everything checks out, and we can generate cash flow for our investors, that means we can hold the asset and we don't have to sell. We can weather majority of the market conditions, okay? So we look for assets that cash flow from day one. Appreciation. This goes back to underwriting the market. We want to understand how we can, put ourselves in the path of progress in these high growth markets, and also take advantage of the value add process where we can increase market rents, decrease our expenses on the project, and add additional streams of income. Again, all of that because it's a commercial asset. All that and net operating income growth can actually help us stabilize this appreciation number for us. And then number 4, the tax benefits. Okay, tax benefits for real estate operate very differently, as I alluded to in the SDIRA. However, you still get to maintain them. You just can't use them personally. So make sure that you're working with your CPA and your legal advisors to understand how to best leverage those tax benefits. But if you put an asset in SDIRA, you're getting tax benefits at that level. So again, don't be, make sure that you're being, doing your full due diligence on, how to leverage these tax deferred accounts with tax deferred investing in order to maximize your growth. Go to this website, goodeggsinvestments.com, free course, and we'll walk you through a 7-day course where I go over a lot of this information in greater detail.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.